All right, let's dive into the company's Auditor's Report Order 2020, commonly known as CARO 2020. This is a critical area for your CA final exams, so let's break it down clearly. First, let's talk about applicability. The general rule is that CARO applies to every company, including foreign companies. Also, keep in mind that CARO generally does not apply to consolidated financial statements, with the exception of Clause 21 of Paragraph 3.
However, there are specific exemptions you need to memorize. CARO will not apply to one-person companies, insurance companies, banking companies, small companies, Section 8 companies, and a specific category of private companies.
For a private company to be exempt, it must not be a subsidiary or a holding company of a public company, and it must meet 3 financial criteria. Its paid-up capital and reserves and surplus must not exceed 1 crore rupees. As of the balance sheet date, its total borrowings from banks or financial institutions must not have exceeded 1 crore rupees at any point during the financial year, and its total revenue, including discontinuing operations, must not exceed 10 crore rupees.
First, we have property, plant, and equipment, and intangible assets. As an auditor, you need to check if the company is maintaining proper records with full quantitative details for both PPE and intangibles. You must verify if the management has physically verified the PPE at reasonable intervals. Finally, check for any pending proceedings against the company for holding Bainami property and ensure it's disclosed in the financial statements.
A very important point here is the title deeds of immovable properties. You need to ensure that title deeds for all properties disclosed in the financial statements excluding leased proprietaire held in the company's name. If they aren't, you'll need to provide a detailed table including the description of the property, its carrying value, who holds the name, the period held, and the reason why it's not in the company's name.
Next, let's look at inventory. You need to report whether physical verification was conducted at reasonable intervals and if the coverage and procedure were appropriate. If discrepancies of 10 or more in aggregate for any class of inventory were noticed, you must check if they were properly handled in the books. Also, if the company had working capital limits exceeding 5 crore rupees sanctioned by banks based on current assets, you must verify if the quarterly statements filed by the company match the books of account.
Finally, let's discuss loans, investments, guarantees, and securities. You need to determine if the company has provided loans, guarantees, or securities to companies, firms, LLPs, or other parties. For companies whose principal business is not giving loans, you need to report the aggregate amount provided during the year and the balance outstanding at the balance sheet date, specifically breaking this down between subsidiaries, joint ventures, associates, and other parties.
Now, let's dive into the core of the CARO 2020 requirements. This section is critical because it deals with the movement of money, how it's lent, how it's borrowed, and whether the company is following the law.
But it's not just about the numbers. You need to evaluate if the terms and conditions of these loans are prejudicial to the company's interest. In simple terms, did the company give a loan on terms that are too lenient or risky? You also need to verify if there's a clear schedule for the repayment of principal and interest, and if those receipts are actually coming in regularly.
If there are overdues, pay close attention. If an amount is overdue for more than 90 days, you must report the total amount and check if the company is taking active steps to recover it. Also, look out for evergreening of loansthies, is where a company grants a fresh loan just to settle the overdues of an existing loan to the same party.
Moving on to the legal compliance side, you must verify if Sections 185 and 186 of the Companies Act, which govern loans to directors and investments by companionship, been complied with. Similarly, for deposits, check if the company has followed the RBI directives and Sections 73 to 76 of the Companies Act.
Next, we have cost records. If the central government has specified under Section 148 that the company must maintain cost records, you need to confirm whether they are actually being maintained. Now, let's talk about statutory dues. This is a very common area for audit observations. You need to check if the company is regular in depositing undisputed government dues. If any undisputed dues have been outstanding for more than 6 months from the due date, you must indicate this.
Regarding income tax, you need to check if any transactions that were not recorded in the books of account were disclosed as income during tax assessments. Finally, let's look at loans and borrowings. You need to report any defaults in the repayment of borrowings or interest. If there is a default, you'll need to provide a detailed table including the lender's name, the amount not paid, whether it was principal or interest, and the number of days of delay.
Now, let's dive into the remaining clauses of CARO. We are looking at some very critical areas of financial discipline and compliance here.
First, let's talk about loans and funds. Under Clause C, you need to check if term loans were actually used for the purpose they were taken for. Similarly, Clause D asks if short-term funds were used for long-term purpose, which is a classic sign of liquidity stress.
Moving to IPOs and fundraising in Clause X, you'll check if money from an IPO or FPO was applied for the intended purpose. Also, for preferential allotments or private placements, you must ensure compliance with Sections 42 and 62.
Now, let's look at fraud in Clause I. This is a high-priority area. You must report any fraud by the company or on the company. For NIDHI companies in Clause XII, there are 3 specific checks. The net owned funds to deposits ratio must be 120.
Next, Clause XIII deals with related parties. You need to verify that all transactions are as per Sections 177 and 188. In Clause XIV regarding internal audit, check if the company has an internal audit function. Clause XV covers non-cash transactions. Check for compliance with Section 192.
Finally, let's look at RBI and core investment companies, or CICs, in Clause XVI. You need to verify if the company is required to be registered under Section 45IA. And if the group has more than one CIC, you simply indicate the number of CICs within that group.
Now, let's dive into the remaining clauses of CARO. We are looking at some very specific and critical reporting requirements here.
First, let's talk about core investment companies, or CICs. Under Clause 16, the auditor needs to verify if the company is a CIC. Moving to Clause 17, we have cash losses. This is straightforward. You must state whether the company has incurred cash losses in the current financial year and in the immediately preceding financial year.
Clause 18 deals with the resignation of statutory auditors. If an auditor has resigned during the year, you need to report it. More importantly, you must check and state whether the incoming auditor has taken into account the concerns raised by the outgoing auditors. Now, Clause 19 is a heavy hitter going concern.
Next, we have CSR requirements in Clause 20. There are two parts here. Finally, Clause 21 covers Consolidated Financial Statements, or CFS. You need to check the CARO reports of all the companies included in the CFS.
To wrap this up, there is a very important general rule regarding these answers. Whenever your answer to any of these questions is unfavorable or qualified, your audit report must state the basis for that conclusion. Similarly, if you are unable to express an opinion on any matter, you must clearly indicate that fact and provide the reasons why it wasn't possible to give an opinion.
Now, let's dive into Section 143 of the Companies Act, which outlines the critical duties of an auditor. This is a high-yield area for your exams, so pay close attention to the specific requirements.
First, we have the duty to inquire under Section 1431. Think of this as the auditor's investigative phase. You aren't just checking boxes, you are actively inquiring into specific risk areas.
Moving on to Section 1433, this is the duty to audit report. Under the section, Report on Other Legal and Regulatory Requirements, you must state several key points. You need to confirm if you obtained all necessary information, whether proper books of account were kept.
Now let's talk about internal financial controls. You must report on whether the company has adequate internal financial controls in place and their operating effectiveness. However, there's an important exemption here.
Finally, we have the other matters prescribed under Rule 11. This is a detailed list. You must check for the disclosure of pending litigations, provisions for foreseeable losses, and whether the company used accounting software with an audit trail feature.
First, we have the reporting to the central government, or CG. This kicks in if the auditor has reason to believe that a fraud involving an amount of 1 crore rupees or more was committed by the company's officers or employees. There is a very specific process here. First, the auditor must report the matter to the board or the audit committee immediately, and definitely no later than 2 days after they become aware of the fraud.
They will seek a reply from the board or committee within 45 days. Once that reply is received, the auditor has 15 days to forward their report. If no reply is received within those 45 days, the auditor doesn't wait, they forward the report to the CG, along with a note explaining that the report was sent to the board, but no reply was received.
Regarding the logistics, the report must be sent to the Secretary of the Ministry of Corporate Affairs in a sealed cover via registered post with acknowledgement due or speed post, followed by a confirming email. The report must be on the auditor's letterhead. Specifically, this must be done in Form ADT4.
Now, what happens if the fraud is less than 1 crore rupees? In this case, the auditor reports the matter only to the audit committee or the board immediately. This report must specify the nature of the fraud, the approximate amount involved, and the parties involved. Following this, there is a disclosure requirement in the board's report.
If an auditor fails to comply with Section 14,312, the penalties are steep 5 lakh rupees for listed companies and 1 lakh rupees for other companies.
A very important point for your exams: reporting these frauds in good faith is not considered a breach of confidentiality. Furthermore, these reporting rules apply mutatis mutandis to cost auditors and secretarial auditors as well, Remember that the auditor must report fraud under Clause 11 of CARO 2020. Finally, if any matter is answered in the negative or is qualified, the auditor must clearly state the reasons.